Again, welcome to the UST Educational Webinar Series. My name is Mike Caniff, and today we're going to start off with just some overview topics, get into some details on the budgeting process. This is going to be more general discussion topic. This is really where we're talking about the best practices, and then we'll look at budgeting products for NetSuite and break it into these three different areas: budget planning, control, and reporting side of things. And then we'll wrap up after that. So that's our general agenda for today. As Marsh showed earlier, these are the course details and objectives. With any, I think, technology or business process, there comes a so-called hidden language, right? And we're going to talk about some of the terminology today, terms like commitments or encumbrances, right? And so some of you may or may not know about those. So we'll dive into that as we go through the presentation. We'll get a general idea of on how organizations create budgets. What is that general process? What's the difference between a budget and a forecast? And so we're going to talk about that. And then we'll look at a variety of different types of budget versus actual reports. But we're going to look at some different flavors of that. And then finally, we'll also discuss some of the technology that's involved. So as some of you put in the comments there, you've, in a sense, lived most of your career dealing with budgets. Organizations spend a lot of time working with budgets and establishing budgets, tracking budgets, adjusting budgets throughout the year. Why do we do that? And I think the first area here is this idea of focusing on profitability. Most corporations that are for profit, of course, care about generating a profit. On the nonprofit side of things, the focus there is on not losing money, right? You don't want to be losing more money than you're bringing in from, say, your grant revenue. By focusing on profitability, we can break that down into these two components: revenue, expenses, right? That's your basic P&L. So the budget process forces management to look at the anticipated revenues that are coming in throughout the next year, or maybe up to 5 years, and do a more accurate job of forecasting that revenue. And then, of course, associated with any revenue increases may be expense or expenditure increases, because if I have to hire more people to produce more widgets or sell more product, then I'm going to increase my expenses along with that revenue. And so we want to make sure that we can enforce those limits on expenditures, that we don't go over budget. So if we're doing well on both, are we accurately predicting our revenue and we're actively controlling our expenses, then our profitability should increase, and we should be able to meet the mark of what our goal is for profitability. Then once we do that process, or we understand the profitability side, that forces us to look at a variety of different business assumptions. You know, what's going to be the cost of energy over the next year? Is that going to be going up or going down? That's going to factor into our expenses as far as running various capital projects, various operations, et cetera, right? What's the cost of our salaries, right? Salaries rarely go down. So what is the increased expectations over the next 3 to 5 years for salaries, right? So those are various assumptions that are going to get baked into the budget. From there, we can start to generate cash flow projections to look at, are we going to be hurting in a particular quarter, especially if we are a seasonal type of organization, selling a lot of snow shovels, let's say in the late summer and early fall. That should be our big season, right? So are we going to have enough cash flow in the good times as well as in the lean times? And then from there, we can allocate cash more effectively across any fixed assets that we might be purchasing, what's our working capital, and ongoing operating expenses. So these are some of the benefits, right? Once we do this analysis, we can then more effectively allocate cash, understand our cash flow better, et cetera. Those are the goals out of creating the budgets. And I guess primarily keeping an eye on expenses. So now let's take a look at the budgeting process. This is fairly high level. Generally, we look at 3 to 5 years worth of financial forecast. It forces management to think proactively. Where are we going to anticipate growth, new products, maybe new services that we might offer if we're a nonprofit organization, things like that. So we're going to receive input from a variety of stakeholders. This could be internal and external stakeholders within the organization. Once we make everything align with our vision, understand the needs, the expenses that might be associated with it, and then from there we can establish our budgets. Once we create the budgets, then that's going to drive some decision making as far as when we might procure various items. So again, if we're looking at let's say a plant expansion and we have to purchase various fixed assets for that plant expansion, which month or which quarter are we going to be making those investments? Maybe we're going to implement a new ERP and budgeting system, and that's in the books. Or maybe the existing one is we're running an old system from 20 years ago and we want to revamp that. Typically, we might do that right at the beginning of the year. So then that means we have to procure that in advance, let's say 6 months or 9 months in advance to go through an implementation process, right? So those are some of the decision makings that will factor into the budget process. We also have to identify, is this from within each organization, is it a centralized or a decentralized process? A lot of the organizations I work with have a centralized FP&A team, and they're responsible for establishing the budget, keeping an eye on it, reporting against the budget, etc. But other organizations will take input from a variety of different business units and then aggregate that upwards to come up with the final budget numbers. So again, these are just general approaches. Let's take a look at a little bit more detail. Typically, we start out from an operating budget perspective with a revenue calculation or forecast. So we start on the revenue side of things. That typically then derives our production budget. So in this example, we're looking at is more of a manufacturing or goods production type of environment. So we will generate a production budget, which will impact our direct materials, manufacturing overhead, etc. So now we're starting to get into the expenses here in the middle. What's it going to cost to be able to meet these revenues? That will feed into a cost of goods sold budget overall, that final calculation. From there, we end up with a overall income statement with the budgeted amounts. From there, we feed that back into our balance sheet. Most of you that are in finance, this is probably old stuff, right? This is kind of standard accounting practices to be able to go through that process. In a nonprofit organization, it might be slightly different because we're not dealing with the manufacturing process, but you still have to look at revenues from the perspective of how many grants are we going to apply for in the next year or maybe 3 years? What type of revenue do we expect to receive from those grants? And then that will allow us to expand services or maybe start a new service in an area that we had not currently been involved in, right? So of course, we need to make sure that those services align with our overall mission. So just a different perspective, but the same general process that you want to go through, whether you're nonprofit or a for-profit organization. So now what I want to do is break the topics down into 3 main areas. The first step is the planning and forecasting process. Then we're going to get into operational controls, or just how you monitor your budgets. And then finally, we'll look at reporting. So those are the 3 main areas of topic for today. And then we'll wrap up. Of course, we'll circle back and talk a little bit more about the NetSuite ecosystem. So starting off, step 1, when you're establishing your budget, typically within an organization, you want to assign that to an owner. Again, in a small company, that might be the head of the accounting department or the person that wears all of the hats. In a larger organization, that is going to be your FP&A team. You're going to receive input from your budget managers as well as potentially external stakeholders. So in this diagram on the right, this is actually more of a nonprofit or a public sector life cycle. So notice that the fiscal year is starting in July and not based upon calendar year. So if we back up a couple of months, we're looking at getting input in the form of a public hearing. Oh, so good question. What is FP&A? So that's some of the terminology. It usually stands for Financial Planning and Administration Department within a company. Usually that's part of your overall finance department. It's usually separate from, say, your accounts payable or accounts receivable departments. So back to my example here with transit district, and I've done a lot of work with transit districts in the past. They'll establish a budget, let's say in the March, April timeframe. and they'll receive input from, say, the IT department, the bus repair and maintenance or train repair, the ongoing operations, the route management and all of that. But then as part of their charter, since they are a public agency, they have to have a public hearing and review the budget with external stakeholders. And so then they may receive additional input from those external stakeholders to finalize the budget, let's say by mid-June timeframe. So then they can publish that, or actually make sure it gets all approved, and then publish it for operations starting on July 1st. So that's a typical upfront planning process that a lot of organizations would go through, or especially in the nonprofit and public sector space. So what's the difference between a budget and a forecast? And a lot of times these terms are interchangeable. A lot of times I'll be in meetings and they'll say, here's our forecast for the year. What they really meant, this is our short-term budget, or it could, again, depending on different timeframes. But more classically, what's termed is the budget is typically a 1 to 3 or maybe up to a 5-year time period. It's typically fairly static in that you establish a budget, you may revise it on an annual basis. You typically also have different versions of a budget, your worst case, a nominal, and best case, and then you typically approve the nominal case. You could have different flavors of that. You might slice it by product or area. And so that's typically what goes into a budget, whereas a forecast becomes more of an annual process, and you would revise it more frequently. Let's say on a quarterly basis, I'm going to do a budget adjustment based upon the previous quarter's actuals. So we start with the annual budget, we break it down by quarter, that's our forecast, it becomes our tactical plan. And then we might use a concept called a rolling forecast as each period closes. And then from there, we should be able to identify any gaps. Do we have excess budget remaining in a particular period that we then want to carry forward into a new period? Or are we over budget and we need to scale back spending in the corresponding period coming up? In different areas that we look at from a budgeting perspective, we talked about revenue, right? That's usually the starting point. You might need to break that down either by business unit or by product. Different organizations will do that differently. Oh, actually, I just seen a question that came in here about with a world with so much change and opportunity, are 3 to 5 years budgets being done? And that's a good point. I think anybody that put together a 3-year budget back in 2019 had a rude interruption in their budgeting plans for 2020 and 2021. And also given the state of some of the technology today, the fact that we can react real time and update budgets more frequently, we have better communication to gather input. Maybe a more realistic target is a 1 to 2 year budgeting time frame. What you're really looking at is a more strategic 3 to 5 year business plan. So that's some good input there. A 3-year strategic plan and then budget for 1 year at a time or forecast. Again, depending on how you want to use the terminology there. So next, after we look at the revenue, we want to break things down by expenses. Are they fixed or variable? Right. So, and again, most of you have accounting backgrounds, you understand what that means. But then let's say, for example, on the fixed side of things, we have to factor in anticipated increases for rent and insurance or other just inflationary related items, utilities, things like that. We also include any other capital outlays, staff increases. So those are all inputs, numeric inputs or drivers into our budget. Now, when we create the budgets, and I think we've had some feedback already in the chat on this, is that do we do a bottom-up approach where we collect plans from managers? Well, that works if managers are being honest, right? Or if they're, able to publish the numbers on a timely basis. You don't have to bird dog them and chase them down to get the latest information, right? Or the salespeople, do they want to commit to the revenue numbers, right? So that can be a challenge with the bottom-up approach. But of course, that tends to get the most accurate input if you can get that data in a timely manner, because these are people that are directly responsible for the various expenses and the revenue. Then at that point, we're going to roll that up to, say, the business unit level for the total budget. Alternatively, again, if you have an FP&A team, that financial planning and administration team, they may establish the budget. Will probably go from last year's budget tack on a 10% increase like peanut butter across the board, and then from there drive it downwards or delegate that out to managers for specific allocation. So that's another approach. Most companies will probably do a combination, right? Where the FP&A team starts out with the peanut butter approach, then you get input from the management at the lower levels, and then bring that together to finalize your budget. And that's why the process can typically take, a couple of months throughout the year to create your initial annual budget. So you may be taking, October, November, maybe your budget planning season, right? And then everybody goes on holiday for December and comes back in January with a brand new budget. So from a maturity perspective, and this is kind of where we get a little bit more into the best practices, most organizations have been doing budgeting for decades, right? And going kind of through that process, create the budget, establish it, we have next year good to go, and we run off that for the remainder, for the following year. Then, of course, with ERP systems, we can generate lots of reports and do budget to actual reporting. But then you want to get into more of the forecasting, the more near-term tactical type planning, which ultimately drives you toward agile planning and being able to track things and enforce your budgets from a transactional perspective from your ERP systems. So let's talk a little bit about that rolling forecast concept. The traditional model, as I've mentioned before, is I would establish a budget for 1 year. And let's say I've got my actuals here are in yellow. So in Q1, I've got, these are my actuals, and then I have a prediction for the rest of the 9 months, what's going to be in my forecast. As I move through the year, I'm getting more actuals, but I'm not extending out my forecast beyond the year-end wall that's shown here in the diagram. On the other hand, with a rolling forecast, the idea is that I keep tacking on another quarter or whatever period, maybe it's a monthly, but quarterly is usually sufficient. I'm going to tack that on so I continue to see what's going to become in the 12-month horizon of the future. So I always have this fixed number of months projected in the future. And this allows me to continuously update or adjust my budgets based upon the actuals. And that's based upon various key drivers. We'll talk about that next. What do I mean by drivers here? This also then gives you the ability to generate what if analysis types of outcomes. What if we ramp down our expenses? COVID-19 hit. What do we do with that, right? I'm sure budgets were adjusted severely back in the April timeframe of last year. So then a rolling forecast allows us to focus on that fixed number of periods going out into the future. So I just seen a comment in here. Yeah, a lot of people, I would think, as you go further out in your time frame, they don't have as much trust in what that forecast looks like. And that trust is, of course, a key factor. Is if you don't believe in the budget, that's going to be a challenge to actually maintain your expenses. All right, so I mentioned this idea of driver-based forecasting. And the basic idea here is you have a variety of metrics, right? And these are things that hopefully most of you are tracking. Again, it depends on your type of business. So if I'm in let's say a software as a service business, I'm going to be tracking what are my number of new accounts? What's my churn rate, right? How many accounts am I losing versus gaining on a month-to-month or quarter-by-quarter basis, right? So those are key metrics that I want to be able to project going into the future. If I'm more in the utility business, I might be keeping track of transactional. How many bills am I generating and things like that. In the nonprofit space, I might be tracking number of people served or number of grants that I'm receiving and the total amount of grant revenue that I'm going to be receiving. So a variety of different metrics that I might be able to track that way, depending on my industry. If I'm in a distribution, number of units moved, et cetera, right? So we see these broken out by industry as typical drivers. Then on the expense side, how many people are on the payroll right now, right? My FTEs, contractors, what's that mix, right? What's the right mix of that? And I can take then a lot of this data, all of these silver balls, if you will, and I'm sorry, these would be the red balls, right? The cause based upon these numbers, what's the effect? How is that going to impact my expenses? So if I'm a spreadsheet jockey, I should be able to put the metrics in at the top with my projections, and then from there, see the effect that's going to be on my salaries, bonuses, occupancy, stationery, whatever else, whatever my categories are on the bottom. So I have a variety of formulas with percentages. Most of you probably have something like this in Excel already. But the idea is I'm based on not just, talking to a manager thinking that, okay, I'm going to spend X number of dollars next year or next quarter. These are the specific numbers that we're going to track within the enterprise. And then that's going to drive the rest of my revenue and expense calculation. All right, so next, let's shift our attention a little bit here to off-the-shelf software for doing the implementation. So now I'm talking a little bit more about budgeting software, say beyond Excel. This gets back to my original question about if failure is always an option. If you failed on an implementation, typically the challenge is getting participation outside of that FP&A, the finance team, to actually use the software. So again, outside of Excel, right? Everybody has Excel. You can ask all of your line managers to generate an Excel spreadsheet showing, or give them a template and say, here, fill this out for your anticipated expenses, right? And then resubmit that. That's relatively easy. But what I'm talking about here is more the enterprise budgeting tools such as Adaptive Insights or Oracle PBCS, where you want to have a centralized software component to be able to track all of the changes to the budget, and you want input from everybody within the company. And so are you able to get them to adopt usage of that software? And so some of the recommendations here is to set up the software for the core users, right? The finance team initially, and get them used to the way the tool works and how you can establish the budget. Most of these tools will allow you to create the budget and then export that to Excel. And then you could share that with all the rest of the stakeholders within the company. Everybody can review it and provide feedback, and then your FP&A team or finance team can update the budget within the software. As you start to roll that out, you need to make sure that what is it going to cost to train all of the users? That is typically a forgotten part of a lot of enterprise software implementations. I've been involved in many of these over the years, but we forget to train people on how to actually use the software. And so you want to make sure you allocate enough budget to actually train and use the budget software. And then another common factor of failure is you end up with some junior level consultant fresh out of their MBA program that really doesn't know how to use the software. So you want to make sure that if you are going to implement budgeting software, and I think a few of you at the beginning may have just started your NetSuite implementation or just going live and you want to do budgeting, make sure you get experienced personnel on that implementation team to be able to assist you through that process. Now, when we look at a budget planning tool, what are some of the components that we want to identify? Since most of us are familiar with Excel or Google Sheets, the user interface should be very similar to a spreadsheet. I mean, I think budgeting, probably if you go back to paper and pencil, 60 years ago, it was in a spreadsheet format, rows and columns, right? Expenses, quarters as my columns. That's kind of the standard UI, if you will, for doing a budget. So you want to make sure that the budget planning tool pretty much adopts that same format. You want to be able to have it data-driven. And what I mean typically there is I want to be able to import, let's say, last year's actuals as a driver for this year's forecast, right? That's one feature or capability that a lot of these software companies or software tools support. Or I might be able to, by statistics, what I mean there is maybe I want to apply a formula of some type across my revenue and expenses on a period by period basis. And so then that'll drive the modeling rather than having to hand enter in all of my data. And then, of course, I need to be able to save multiple versions of my plan. Again, I talked about that earlier. My best case, my worst case, my nominal. What if something happens? What if we land that great big deal? From a software company, I've got a big whale of a customer out there and I want to land that one. And if that comes in, well, now we're going to have to hire 3 or 4 more consultants to do that implementation. And so how do I manage that? In the nonprofit side, what if we get that federal grant that we've been applying for the past 2 years from the National Institute of Health, and we get it, and it brings in a couple $100 million of revenue into our company or into our nonprofit? What are we going to do with that, right? So that's the what if modeling that I'm referring to here. That should be relatively easy to set up and use within the tool. From a time frame perspective, obviously we need to be able to budget by 1 year, but can I budget by 3 years? Multi-year budgeting. Can I break it out by quarter? Can I break it out by month? Right? I could have a variety of different time frames that I need to do the analysis by. Again, when I'm doing the planning, it would be great to see side-by-side actual. And what I mean by that is for each row of expenses, let's say that I want to see Q1, Q2, Q3, and Q4 actuals. And then right next to that, here's my forecast. So the actuals might come from last year, but they're populated for the current year that I'm forecasting for. I think that's a nice UI to be able to look at and see how my performance is. And then, of course, what we just talked about, the idea of a rolling forecast. Does your tool support that? Or is it kind of lined up year by year when I'm creating the budgets? So those are just some of the typical features that I would recommend looking for if you are evaluating a budget planning tool. So here, I'm going to show you an example of a typical budget planning tool. As you can see, here's our spreadsheet format. We have our previous years, fiscal year 2017 and 2018 in green. Here's our current year that we're working with. And then we've broken it out on a month-by-month basis, starting in, let's say, a fiscal year of July. So that would be a typical UI that I'd want to be able to work with. I want to be able to take an amount, let's say the July value, and then copy that all the way out to the right, for the remaining periods of the year. So that should be a built-in feature. Alternatively, I might want to go the opposite direction and start at the end and say, okay, I know I have $10,000 to spend for the entire year. Let's spread that like peanut butter across the various periods, July, August, and September, right? And then break that out. Or actually, this would be by quarter. So I have my fiscal quarter, first quarter here starting in July of 10,000, and I'm going to break that evenly as 3,300 for each individual month. So again, this depends on your business, right? If you have fairly standard expenditures throughout the year, then this idea of using a breakback and just allocating an annual amount and spreading that across on a month-by-month basis, that works fine. On the other hand, if you have more of a seasonal driver where various products are more in demand at different parts of the season, then you'll want to be able to go in month by month or period by period and specify your individual amounts and be able to free up and have varying amounts for each period. So let's move on to step 2. And this is actually an area that a lot of companies don't bother with, surprisingly. So in other words, you may create the budget. Typically, like in a family, right? You may have a family budget, and then you decide, hey, you know what? Hey, I want to go on vacation. Let's head over to the Grand Canyon, and that's just going to blow out our budget. And so we don't control the budget, right? We just create it, and it looks nice on a spreadsheet, but we never actually review it. And so this is what step 2 is all about. How do we enforce control within our operational system? So now we're going to shift gears and talk about ERP, or our accounting system, financial accounting systems. How do we identify transactions that may be over budget? How do we then alert management that we are over budget? And then manage updates to the budgets, right? Because again, we talked about in the past couple of slides of that rolling forecast. If I'm doing a quarter by quarter update to the budget, I need to be able to push that into the ERP system and have that system reflect the new numbers for the remaining quarters of the year. So this is a little bit of terminology here. Budget enforcement is sometimes called budgetary control, commitment control, or encumbrance accounting. So all same terms or different terms for the same thing. In the nonprofit world, that's where encumbrance accounting tends to be the most commonly used term. Public agencies and nonprofits will use that term encumbrances or encumbrance accounting. For-profits, if you're doing this, will use maybe the term commitments and commitment controls. You want to be able to track every expense throughout the organization. So your payroll, your procurement processes, expense reporting, other things, anything that's where you're spending dollars. you want to be able to enforce the budget. And so then again, that includes a variety of different transactions. You want to have it real time so that as soon as I create a transaction in the system, I am being warned if I go over budget. Or maybe I have a button that says, do a budget check on this transaction. And maybe you won't allow the transaction to be approved unless that button has been clicked and there was a budget check and funds are available, right? Or you just mark the transaction in some way that it is over budget, and then you can route that through specialized approval processes to make sure. And we'll talk about that in a second as well. So now let's look at what we mean by encumbrance or encumbering against a budget. So, of course, I went to the source of all truth, Wikipedia, and figured out that, the definition is that it reflects a commitment or an obligation by the company for a particular expense. And then we can break that down into these three different buckets, if you will. A pre-encumbrance, or sometimes it's called a soft commitment, is an amount that you expect to spend, but you haven't legally been obligated to spend it yet. So a purchase requisition is a good example of that, right? I create a PR, I want to buy some more laptops for the IT department. So I generate that, and then I may need to route that internally for approval, but I haven't gone out to the vendor and signed a contract yet, right? So there's no obligation on the part of the company to buy the laptops, but I can count that against my budget. So I can look at that as a particular effect to the budget because I'm anticipating that I'm going to be buying those laptops coming up in the next year. On the other hand, an encumbrance becomes that legal obligation. Now I've signed a purchase order to buy the laptops, and the signed purchase order, I may have different delivery dates, et cetera, within that, but I'm committing to that purchase. So now that's going to count against my budget. A lot of financial software products do not count encumbrances against the budget because what they're looking at is a true expenditure, what's called sometimes a GL impacting expense. So that's going to show up on your balance sheet and on your profit and loss statement. It's a GAAP requirement. You've expended that amount, right? So that's where you've received an invoice from Dell for the laptops. Now I'm going to write a check or make an electronic payment for those laptops, right? So that's my expenditure that's occurring. Now, the idea of encumbrance, it's related to accrual accounting, but not exactly the same. And to be honest, I don't understand accrual accounting as well as I understand cash accounting, but the general idea is accrual accounting takes into account things that you haven't actually expensed. And a lot of times what you'll do at the end of a period, end of a month, is you'll do an accrual journal entry to reflect anticipated expenses that are coming up, but you actually haven't spent for. I probably butchered that definition. Maybe if somebody in the chat area can correct me on that one, that would be helpful. But this idea of the encumbrance process is key because this is what you want to use to control your budgets. Chris just asked the perfect question: does NetSuite offer functionality to manage the encumbrance process? That is actually done by Piango, right? So that's the one of the reasons I'm delivering the presentation today. I'll actually show you some screenshots here in a little bit on exactly how Piango does that. And so real time, it will check to a transaction to see if you are over budget. Now, in addition to just, I'm going to create a PO, what happens if I have different kinds of budgets? Operations versus capital, with different, in NetSuite terminology, uses different segmentation. So most budgets are established operationally by, let's say, business unit, GL account, such as travel, meals, utilities, and cost center or department, right? Those are kind of the standard segment. But then if I'm doing CapEx, I might add in projects. We'll talk a little bit more about segmentation here as well. So if I have special projects, I might want to be able to handle different kinds of budgets. I might want to roll up budgets to a parent level. So I've got the overall finance department, but finance might include IT, accounts payable, accounts receivable, departments within that. So do I share all of the budgets between all three of those individual departments, or maybe locations, whichever dimension that you want to share your budgets on? Do I need to enforce at multiple levels? So in other words, I might track against, say, the IT department to make sure to validate all of their transactions for the IT department. But if they go over budget, not a big deal. But I want to make sure that the finance division is not over budget at a parent level. And I want to control at that. Or maybe at the project side, I might have individual tasks of a project go over budget, but the overall project better not go over budget, especially if this is a billable project to a customer. So I need to make sure that I'm not going over budget at that high level, right? So those are more complex scenarios that we need to be able to support. And so this is an example of that kind of that linking together where I have detailed amounts, 10,000, 15,000, and 20,000 for each individual department. But then at the admin group level, I have 50,000 as my total. And so as long as I don't go over 50,000 for the aggregated travel account and the admin group, I'm okay. I'm allowed to go over budget, more of a warning process. But then I'm going to control at that parent level. All right, so let's take a little bit of a deep dive into the procurement process. Say I have an initial budget of $1,000. I do a requisition for 100, and then I approve that requisition. It was a pre-encumbrance. Then when it becomes a purchase order, it becomes encumbered or obligated. And then finally, it becomes a voucher or a vendor bill in the system and it's expensed. Do you want to enforce it as soon as the PR is created? So in that case, yes, it's 900. That's my remaining budget. On the other hand, I might want to look at what's called an available budget or available to commit budget. So then that means it's 1,000 in this first stage, and then it reduces to 900 after I approve my PO. So it's interesting. What does GAAP require? GAAP would require the expense over here. GAAP does not necessarily care about the obligations or especially the requisition stage. And that's why a lot of software products, the ERP systems, don't really give you these numbers. They just give you the expense amounts over on this side. And then, of course, you also need to handle these other scenarios. What happens, let's say I order 100 widgets from a vendor. I create the PO. I've committed it. And then I only receive 90 of the widgets. And I have a voucher or vendor bill for 90. So then I'm going to close out the PO of the remaining 10. So when I do that, I'm relinquishing that commitment. Therefore, my remaining amount should be able to go back up. The software needs to be able to account for that. A vendor credit is basically where I'm taking a credit from the vendor that should decrease my expense and increase my remaining amount. Journal entries, right? Those also, a lot of times those are done on the side, but a debit typically would increase your expense where the credit reduces the expense. Expense reports are tricky because a lot of times they're done in a separate best of breed expense solution, say from Concur or Expensify is a couple that I've worked with. And a lot of times they have no knowledge of a budget. So they're just out there cranking out expense reports and you have no capability or visibility back into your budget. So that's something you may want to look at on your expense reporting tool. And then you get into amateurizations. So I'm going to buy a software product, right? So I have an annual license renewal period starting in January of every year, but I want to amateurize that expense over the 12 months, right? Because I'm not just using the software in January. I need to be able to do that actually at the procurement level. I need to amateurize it there so that I have a nice spread of my budget impact throughout the year, right? So those are some more complicated transactions. The next slide here, this actually highlights what Piango delivers in the NetSuite platform. So we have what we call a budget ledger that keeps track of the budget impacts, which are slightly different than the GL impacts or the GAAP requirements. And we break it out into that pre-encumbrance, encumbrance, and expense amounts. And you can see on each individual budget line, so this is for the utilities account, admin department, for corporate sales, whatever segmentation is there, we have a $21 encumbrance or pre-encumbrance at the moment. And we've calculated a remaining amount of 170 and a available balance of 200. So that gets back to that previous slide where we break out what's remaining, what you would want to budget check against versus if you rejected these POs, what is your available to commit? And then if I create a new request, I'm going to get a pop-up message indicating to the user that you've exceeded the budget. And from a Piango perspective, we actually support both a warning mode and an error mode. So in the error mode that you're seeing here, the user is not going to be able to save the requisition. They're going to have to fix the transaction in some way to not be over budget. So I've seen a question come in about online purchasing with P cards and things like that. And you're right, it's a little bit more challenging because what you're doing with the procurement card is you're almost pre-spending. And what I've actually seen done lately is more of the move towards a debit card or a virtual card environment, where as soon as it's issued, that impacts the budget. So you have a pre-spending limit. Let's say it's $10,000 that you're going to give to a department manager. And then they have largesse to spend whatever they want for that $10,000. But as soon as you issue the card, that could be considered an encumbrance because it will ultimately be spent out. So yeah, that's another scenario to think about with online procurement. So let's say I am in a warning mode and I have an over budget scenario. I create the PR, I'm over budget. Let's say I'm working and I'm involved with a project. So project exists. Actually, this should probably be reversed. The yes, no, the project manager should review it and then update it. And then if the project does not exist, maybe the budget controller, the FP&A team wants to review it to say, oh, are we over budget in this scenario? And then approve it or reject it, right? So this should be baked into your normal procurement workflow process. And then typically once the transaction is created, you're going to send out an email for approval. And ideally in the email, you want to see what is your remaining amount. So that's shown right here with a link back to the budget ledger in the Piango example that I'm showing. I should also be able to keep track of an audit trail of every budget line item I have. What are all of my transactions, all of my encumbrances, pre-encumbrances, et cetera, that are impacting this particular budget line? And so that should be readily available. I can also then generate alerts so that if I do allow for an over budget scenario, and I basically, in other words, I'm warning for that, I want to check a box to say this transaction is over budget. Which lines on the transaction might be over budget. And then from there, generate maybe a database query and email people to say, we now have 5 transactions that are over budget, route them to the appropriate people to review that. And then I should be able to see that information when I log into my ERP system in the dashboard or get emailed those notifications. We also need to be able to handle budget adjustments. A lot of organizations and companies that I work with, they update their budgets on a quarterly basis. So that will almost be like a refresh where they take the entire set of budget lines and upload those to the ERP system. Then the idea of doing that is if I had either an increase or a decrease of my burn rate, in other words, am I spending faster than what's expected for the year, I can then coordinate or tweak the budget amounts so that for the remaining part of the year, especially if I have budget control in place, I am not going to go over budget for the entire year. So that's fairly common to put a budget adjustment in. I should also be able to do budget transfers. So the idea there, of course, is I need to borrow from the IT group to pay for the finance department's expenses, something like that. And so I need to be able to do a budget transfer. An argument could be made to say, well, that really needs to be done in the planning tool, such as Oracle PBCS. But if it's done there, you need to make sure that that gets pushed back into the ERP monitoring side of things. Alternatively, you could do that in the ERP system and do a budget transfer. Either way, you need to have an approval process to say, yes, somebody signed off on the transfer of money from the IT department to the finance department. And then when I calculate the remaining amount, I should have the original budget plus or minus any transfers, plus or minus any adjustments, and then my actuals that are coming from the transactional system. All right, so let's jump into our last topic here, closing the loop with recording. We'll start with the standard budget to actual and then move into some more complex scenarios. So here is a typical budget to actual report. We have all the different budget lines as rows. These are your various expenses broken out typically in a P&L format. And then we have the budgeted followed by the actuals and then a variance. The variance could be a numeric value or it could be a percent. And so you get to get a percent budget to actual. After that, we might have a year to date. So I have Q1, Q2, Q3, and then my year to date amounts. So that's kind of the typical report. Usually periods are displayed as your columns. So again, now we've got this broken out with monthly. So I've got January, February, March, my budget, my actual, my variance amount, and my variance percent, right? So a little bit more detail here, but still in that P&L format. This is actually a Piango screenshot where I have a best case and a worst case but my budget amount, that's the number that I'm tracking against. So when I calculate my remaining, so you see on this second line item, I have this ocean project number 1, I have a remaining amount of $3,935 based upon a budget of $10,000. But I could have, if I'm anticipating more expenses, I could allow for 11,000 as my worst case, right? And so I could then switch and make that my budget amount. Another one is, let's pivot our data. Instead of having our periods as columns, we'll put our periods as rows and then maybe break it out, in this case, at a high level by income and expense. Then look at percent of budget for each of our periods. And this is a standard consumption report on a month-by-month basis. I can drill down and have my detail on the encumbrances, so I can break that out. A lot of budget to actual reports will not show that. They'll just show an aggregated actual amount, which could be the sum of these 3 columns. I could also then maybe include prior year actual. So right next to it is, here's my current month. This is what happened in my prior year. This is my anticipated budget, and this is my variance. And then year to date after that. So this allows you to do a quick side-by-side comparison of what happened in the last year and what's going to be planned for this year. Of course, with COVID, this is going to mess up a lot of reports, because 2020 was such an aberration that it's going to be very difficult to do year-over-year comparisons. I could also include budget adjustments, or I could break that out, right? So I could have, here's my original budget. Then I have what's been approved as far as budget changes to that original. So then this becomes my current budget. And then from there, I want to look at my current commitments, which again might be the encumbrances plus the expenses. And I've just sum those two numbers together. So this is, again, in NetSuite, this is fairly easy to create a report like this to be able to show the budget changes. A lot of times, again, organizations want to see that because they want to see what was that original budget amount. And I did some changes, but I don't really know exactly what they were. So let me generate a report out of those. And then ultimately, I want to put that into a nice dashboard. So when I log in, I can see all of my data, slice it by period, slice it product, slice it by category, expense category, that type of thing, right? So a lot of different ways I want to slice and dice the budget data. So you want to make sure that your tool can support all of those different dimensions. So to kind of bring things to a close, I'm going to focus a bit here on NetSuite. In the NetSuite ecosystem for budget planning, it's the Oracle Planning and Budgeting, or sometimes it's called NetSuite Planning and Budgeting Tool. For budget control, that's Piengo, my company. For budget reporting, there's also Vena or Solution 7 that can be used. So a variety of different partner products that are available. A couple of quick screenshots from the Oracle side of things. This is the typical user interface from Oracle. To set up your budgets, they can do the idea of spreading budgets by peanut butter approach. And from an architecture perspective, this is actually a separate product. It's an Oracle product, not a NetSuite product. So what they do is they extract data from NetSuite or any ERP, because it can work with other ERP systems, into their cloud-based budgeting solution, and then from there push the data back in to the ERP system. So if you are looking at a planning software tool, realize that it may not be built in directly to your ERP product. And then from the Piengo side of things, we deliver some key performance indicators. This is another reporting technique to tell you which budgets are close to going over. So that gets an idea of your burn down rate of different budget line items. And so you can then drill down and look at the details from there. And a little bit of background about Piengo to wrap things up. Been around since 2012. Our solution is built on top of NetSuite, so it's 100% integrated. So you don't have to worry about pulling data out of your ERP system, bringing it into Piengo, and then pushing the information back in. It has the same security and the same user interface. We have a variety of customers throughout the world in multiple verticals, from fintech to nonprofit to software companies, and we manage hundreds of thousands of budget lines, billions of dollars that are under budgets. Question came in about finance team implement Piengo. Yes, the answer is yes. We actually provide the implementation services from our side. You will not get a rookie MBA graduate to do the implementation. I'll promise you that. We'll help you out with that and work directly with your finance and NetSuite IT people. Let's see, a question came in, budget tools handling utilization planning. Yes, I believe so. Now, utilization planning might need a little bit further definition, but for professional services, I think what you're getting at there is like a billable time concept. And so if I've got a consultant that's on the bench 50% of the time, that of course is a fixed expense from a salary perspective, but maybe flexible expense from a travel perspective. And so the tool should be able to handle that. So then the other question came in about differentiation between Piango and other solutions. So that's a little bit of a apples and oranges type of a question. Piango does the budget enforcement and control within NetSuite. So we're focused on NetSuite. Excel really does more of the budget planning. And you can extract data to do a budget to actual in Excel, or you could run a budget to actual report in NetSuite and then export that to Excel. But they're really serving two different sets of requirements there. And then NetSuite specific question, yes, a Piango user would also need to be a NetSuite user, although you can have what are called the employee center users in NetSuite, which are lower cost licenses. And so you can access some of the Piango data that way. Let's say if I'm on a procurement or I'm buying something, I have an employee center license. In NetSuite, I can create a requisition. I can see if I'm over budget or not at that point. I'm not able to necessarily create a budget or look at the detailed reporting. That I would need to have a full user license to be able to access the detail there. But there's a limited set of data from what's called the employee license. I can even be a non-user to just approve or reject a purchase order, and then have that remaining amount be in the email. Okay, it looks like we're just about wrapped up. Thanks everyone for attending. Really appreciate the participation. This was a great session. Again, feel free to reach out to me and have a great rest of your day.